Welcome to the Deep Dive. This is where we cut through all the noise, take a whole stack of sources, and pull out the really key insights. Basically giving you a shortcut to being genuinely well-informed. I'm John.
And I'm Wendy. We're both staff here at WeWire. And yeah, we're the ones putting together your weekly Stay Wired recap each week.
Now, today's Deep Dive starts with a number that honestly really made us stop and think. According to a 2024 Chainalysis report, stablecoin transactions in sub-Saharan Africa hit about $54 billion.
Wow.
Yeah, that's a huge figure. It accounts for, get this, 43% of the region's entire crypto transaction volume, which was $125 billion.
Yeah.
So the big question we're asking today is, why? Why are these things, stablecoins, becoming so central in Africa's financial world?
And that's exactly what we want to unpack today. We'll look at what stablecoins actually are, explore why they're proving, so vital for cross-border payments across Africa, and then kind of zoom out to see the bigger picture, the broader implications.
Right.
And then after that deep dive, we'll slide right into our full weekly Stay Wired recap. We'll cover the essential market movers, what's happening in the FX corner, key commodity news, and our top investment ideas for the week.
Okay, let's definitely unpack this. Before we jump into how stablecoins might be a solution, we really need to get a handle on the problem itself. So when we talk about traditional cross-border payments in Africa, what are the biggest roadblocks people are actually running into?
Oh, it's a challenging environment for sure. The main issues, you've got really high costs, payments that take ages to process, and incredibly complex, often inconsistent regulatory rules across different countries.
Right.
The World Bank's data really highlights this. They found sub-Saharan Africa is actually the most expensive place in the world to send money home. Think about it, an average cost of 8% just to send $200. The global average is like 6.62%, so significantly higher.
8%. And it's not just the cost, is it? You mentioned time and currency issues, too.
Exactly. It's not uncommon for traditional methods to take days, maybe even longer, for the money to actually arrive and settle. Why? Because it has to go through multiple banks, intermediaries, and sometimes the underlying banking systems are just old. Then layer on top of that the regulatory maze and these persistent currency exchange problems. Something like 70% of African countries face regular shortages of foreign exchange. That makes getting hold of stable currencies like the US dollar really difficult for businesses and individuals.
It's a perfect storm almost.
Pretty much. And you also have worries about security fraud is a concern, plus gaps in the basic infrastructure needed to support smoother payments. All this really impacts everyone, from big businesses down to freelancers and just regular people trying to send money to family.
Okay, so against that backdrop, these challenges.
Right.
How do stablecoins come into play? What exactly are they, in simple terms?
Right. So basically, stablecoins are a type of cryptocurrency, but they're specifically designed to keep a stable value. Unlike Bitcoin or Ether, which can, jump all over the place, these are usually pegged or linked to something much less volatile. Most often, it's a major fiat currency like the US dollar. Sometimes it could be gold or another commodity, but dollars are the main one.
Okay.
So the idea is you get the benefits of digital currency, speed, security, maybe some decentralization, but without that crazy volatility. They're built to be reliable, almost like a digital version of the dollar you can send easily online. A bridge, really, between traditional finance and crypto.
That makes sense. A stable bridge. And I know there are different flavors of these stable coins. What's the breakdown look like? Which ones are most dominant?
Yeah, that's important. Looking at data from DeFlama around July 2025, the vast majority, something like 92.35% of the roughly $255 billion market are fiat collateralized. Think Tether, USDT, or USD Coin, USDC. These are meant to be backed one-to-one by actual dollars or equivalent assets held in reserve.
Got it. The biggest chunk by far.
Absolutely. Then you have a smaller slice, maybe 7.45%, which are crypto collateralized, like DAI. These use other cryptocurrencies as collateral, using smart contracts to maintain the peg. It's a bit more complex.
Yeah.
And finally, a tiny fraction, about 0.2%, are algorithmic stablecoins, like Frax. These use algorithms, basically computer code, to automatically adjust supply and demand to try and keep the price stable. Though historically, these have sometimes proven less stable.
Right. I remember some issues there. So focusing on the dominant ones, the fiat-backed ones especially, how do they use blockchain technology to tackle those problems we talked about, the cost, the speed, the access issues?
Well, the difference can be pretty dramatic. Let's start with speed. Instead of days, settlements can happen in seconds or minutes. That's just the nature of blockchain transactions. Reports from places like Mural often highlight this huge speed advantage.
Seconds versus days. That's huge.
It really is. And then the fees. Often, sending stablecoins costs less than 1%. Compare that to the 8% average we mentioned for traditional remittances in the region. It's a massive saving, especially for smaller amounts.
Okay, less than 1% versus 8% or more. That's a game changer. What about security and reaching people without bank accounts? That seemed like a big hurdle.
Yeah, and blockchain helps there too. The ledger, the record of transactions, is transparent and auditable. That makes it harder to commit certain types of fraud.
Okay.
And maybe the most critical point for Africa is accessibility. If you have a smartphone, you can potentially use stablecoins. You don't necessarily need a traditional bank account. And remember, the World Bank says only about 49% of adults in sub-Saharan Africa have a bank account.
Almost half the population.
Exactly. So, by cutting out many of the middlemen, stablecoins simplify the whole process, slash the costs, and offer a genuinely practical way for more people to participate in digital finance, bypassing some of the gaps in the traditional system. And what's really cool is seeing this play out in the real world already. It's not just theory. Take Nigeria, for instance. You've got small merchants using stablecoins like USDT or USDC to pay suppliers in Asia.
Oh, interesting. B2B payments?
Yeah, business to business.
Mm-hmm.
It means they don't have to deal with the hassle of getting physical US dollars or navigating complex international bank wires. Rest of World actually reported on this trend specifically.
Mm-hmm.
And in Kenya, even the big mobile money players like M-Pesa, which is, massive there, are starting to integrate stablecoins. Why? To make remittances faster and cheaper for their millions of users.
That integration with existing platforms like M-Pesa is key, I imagine. It makes it easier for people to adopt.
Definitely. It lowers the barrier to entry.
And that brings us right back to that staggering number we opened with from Chainalysis. $54 billion in stablecoin transactions in sub-Saharan Africa last year. 43% of all crypto volume. It's clearly not just a niche thing anymore.
Not at all.
And you mentioned earlier how this growth is especially strong in countries with shaky local currencies. Like Nigeria and Ethiopia saw a 180% jump year over year in stablecoin transfers after their currencies took a hit. People are actively using this as a way to find stability, aren't they?
Precisely. When your local currency is losing value rapidly, holding or transacting in a stablecoin pegged to the US dollar suddenly becomes very attractive. It's a practical tool for preserving wealth and facilitating trade.
That makes perfect sense. So if we look ahead now, connect the dots. What's the future looking like for stablecoins in Africa? Is this momentum going to continue?
All signs point to yes. The outlook seems incredibly strong. You have experts like Rob Downs from ABSA Bank predicting stablecoins could actually become the main use case for crypto in South Africa within, say, 3 to 5 years. That's a big statement.
Wow, the primary use case.
Yeah. And we fully expect that $54 billion figure from 2024 to keep climbing, probably significantly as the infrastructure gets better and just general awareness spreads across more countries.
Mm-hmm.
Regulation is also going to play a huge role. When countries like South Africa make progress on clear rules for stablecoins, that gives businesses and individuals more confidence to use them widely. Clear regulations tend to foster adoption.
Right, reduces uncertainty.
Exactly. So looking bigger picture, stablecoins really hold the potential to, dramatically cut remittance costs, make trade much more efficient, and genuinely empower millions who are currently outside the formal banking system.
Right.
All of that can contribute significantly to economic growth.
So it's not just about payments, it's about broader economic impact.
Absolutely. And watch for continued collaborations between African fintech innovators and global partners, plus ongoing investment flowing into the space. This will likely keep accelerating the integration and really position parts of Africa at the forefront of using digital assets globally.
That whole stablecoin story is just fascinating, really showing how innovation can tackle real-world financial friction. But okay, shifting gears now, let's dive into our broader weekly Stay Wired recap. There were definitely some other important moves across global markets this past week that we need to cover.
Absolutely. Lots happening.
Okay, first up, market movers globally. We saw continued focus on China's efforts in AI chips. Seems they're hitting some supply hurdles, especially getting enough high-end NVIDIA chips that could ripple through the tech world.
Definitely one to watch.
Elsewhere, Chile's central bank hinted pretty strongly that an interest rate cut is likely coming soon, hoping to stimulate their economy. But on the other hand, the Netherlands actually cut its economic growth forecast. Why? Mainly worries about the impact of new U.S. tariffs.
Yeah, those tariffs are creating ripples. And speaking of central banks, Korea decided to hold its interest rates steady this week, no change in policy there. Germany confirmed its June inflation came in at 2.0%, which suggests price pressures in Europe's biggest economy are, well, somewhat contained for now.
2%, right on target, basically.
Pretty much. And interestingly, despite or maybe because of the tariff uncertainty, global banks are actually forecast to get a nice 10% bump in trading revenue.
Yeah.
Seems the volatility is creating more trading action. And over in Asia, Malaysia's central bank cut rates their first cut in 5 years, trying to give their economy a boost.
Okay, lots of central bank activity. What about companies? Delta Airlines saw its stock jump after beating earnings expectations. That's a good sign for travel demand, suggesting people are still spending on experiences.
Right.
But for the U.S. housing market, average long-term mortgage rates ticked up again to 6.72%. That continues to be a headwind for affordability.
Definitely.
And here's a really interesting one, blending finance and tech. In Japan, a company called Gates is tokenizing $75 million worth of Tokyo real estate. They're doing it on the Oasis blockchain.
Tokenizing real estate, so like digital shares of property.
Exactly. Turning ownership rights into digital tokens. This could potentially make it much easier to trade property or even own small fractions of it digitally. Very cutting-edge stuff.
Fascinating. Okay, turning to Africa specifically, Nigeria secured a pretty big loan, $747 million, led by Deutsche Bank for a coastal highway project. That's a major infrastructure push. Uganda's state oil company is actively looking for a partner to help develop a new oil block that could be significant for their energy sector down the road. And for traders in South Africa, the platform PrimeXBT launched a Trade as VIP campaign. It just shows the growing interest in crypto and derivatives trading there.
Right.
Also important for South Africa, their big plans for boosting energy supply, especially renewables, really depend on upgrading their national grid. That remains a critical challenge.
Infrastructure bottlenecks again. We also saw Mali in the news, planning to sell some of its gold reserves to raise government funds. That highlights how resource-dependent nations sometimes have to leverage those assets directly.
Yeah.
And a reminder from the World Bank came this week, urging African governments to focus on improving essential services, health, education infrastructure as the foundation for sustainable growth.
A crucial point. And lastly, Mozambique's huge liquefied natural gas LNG projects worth around $57 billion seem to be getting back on track despite some ongoing risks. If those come fully online, that could have a real impact on global energy supplies.
Okay, quite a mix of news there. Let's move to the FX corner. How did key African currencies fare against the U.S. dollar this week?
Well, looking at the week-to-date figures, the Ghanaian cedi actually dipped slightly, but let's keep perspective. Year-to-date, it's still up a massive 29.25%. Really strong performance overall this year.
Wow, yeah.
The Kenyan shilling gained a bit this week, and it's slightly positive for the year, too. The Nigerian naira also saw some gains this week, adding to its modest appreciation since the start of the year.
Okay, so mostly positive moves there, or holding strong year-to-date. How about the rand and the CFA franc?
The South African rand did weaken against the dollar this week. However, it's still holding on to a respectable 5.21% gain year-to-date, so still positive overall. And the West African CFA franc, similar story, a slight dip this week, but it remains one of the best performers this year, up a solid 12.02% against the dollar since January.
Got it. And globally, what were the big currency moves against the dollar?
Well, the British pound fell for the second week in a row, eroding some of its year-to-date gains, though it's still in positive territory. The Canadian dollar also slipped this week, but is likewise still up for the year overall.
Okay.
The big story, though, was the Japanese yen. It saw the sharpest decline this week among the majors, and significantly, it actually turned negative year-to-date for the first time in quite a while.
Ouch, quite a reversal for the yen. And China's yuan.
The yuan depreciated modestly against the dollar this week, continuing its general trend of weakness we've seen throughout the year so far.
Okay, thanks for that currency roundup. Now, commodities corner. Oil seemed particularly complex this week.
Yeah, definitely mixed signals in the oil market. On one hand, the International Energy Agency, the IEA, boosted its forecast for global oil supply growth next year in 2025. They're now expecting an increase of 2.1 million barrels per day, which is about 300,000 barrels per day more than they previously thought.
So more supply coming online, you'd think prices would fall.
You would think, but Inventories, the actual stockpiles, are still surprisingly tight right now. Why? Because summer demand has been really strong for gasoline, jet fuel, and even for burning oil to generate power in some places. So despite the forecast of more supply later, the current tightness kept pushing Brent crude prices up towards that $70 per barrel mark.
Interesting dynamic. Supply forecasts up, but current demand keeping prices firm. What about gold? Still acting as a safe haven.
Very much so. It continues to attract investors looking for protection. We saw data midweek showing that funds focused on gold and other precious metals had net inflows for the 7th week running.
7 weeks of inflows, that's significant.
It really signals sustained demand, likely driven by all the uncertainty around trade, tariffs, and geopolitics. Now, gold did pull back a little bit this week, settling around $3,307.87 an ounce. That might have been some profit taking, or maybe the slightly stronger dollar had an impact after the latest tariff news. But overall, its resilience is pretty clear.
Okay, gold holding its ground despite a small dip. Finally, let's do a quick run through of some of the most active stocks this week. What caught your eye?
Well, NVIDIA, ticker NVDA, finished the week around $164.92, basically flat but slightly up. As a key chip maker for AI, it remains rated a strong buy by many analysts due to that ongoing demand.
Makes sense.
Tesla, TSLA, ended around $346.46. It was down about 3.3% on the week. It's generally rated a hold right now as the electric vehicle market faces, more competition and some pricing adjustments.
Okay. Any other standout?
Let's see. NIO Inc., another EV maker, ticker NIO, was up a bit at $3.90, rated a buy. SoFi Technologies, oh so high, a fintech company, closed at $21.20, pretty flat, rated hold. Lucid Group, LCID, another EV player, was down almost 2% at $2.29, also a hold rating. American Airlines, AAL, had a rougher week, down over 5.5% to $12.22, though it still carries a buy rating. And Apple, AAPL, ended slightly up at $207.22, also rated a buy.
Got it. A quick snapshot of some heavily traded names. And that brings us to the end as another deep dive. We really aim to give you that valuable shortcut, helping you get truly informed on, well, first, that critical and growing role of stablecoins in Africa, and second, all those key market shifts globally over the past week.
Yeah, and hopefully this raises an important point for you, our listener. This information, it's not just, abstract facts. It's about understanding trends that have real-world impact, potentially affecting everything from how money moves globally to how commerce works in the future.
Exactly. And that leads to a final thought to maybe chew on. If Africa, a continent we often label as developing, is actually taking the lead in adopting these new digital currencies to leapfrog traditional financial hurdles, what does that really signal about the future? The future of money, of trade, of financial access for everyone, everywhere. And how might this digital shift, driven partly by necessity in regions like Africa, end up reshaping the entire global financial system, maybe even faster than many of us expect?
Something to keep thinking about.
Yeah.
For the deep dive, I'm John.
And I'm Wendy.
Until next time, keep digging into the insights.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.